Welcome, everyone. We are calling to order the Budget Committee meeting for August 21st, 2024. And I will go ahead and turn it over to staff. I did not bring an agenda with me, nor my laptop.
Okay, thank you everybody for coming today. We have a couple presentations from some bond underwriting firms as we prepare to build the Public Works Operations Center and take on some debt financing for that. So we're starting with Hilltop Securities. Them introduce themselves.
Oh, first, sorry, I need to step back. We need to approve the minutes of the budget. See, this is what happens when you don't bring your agenda with you. The April 23rd, 2024 meetings. So do I have a motion to approve the minutes?
So moved.
Second.
All right, it's been moved in second. All those in favor signify by saying aye.
Aye.
Okay, minutes have been approved. So, thank you so much. All right, now we can go on with the next presentation. Sorry for the interruption.
No worries. Madam Mayor and Council, my name is Lindsay Savdi with Hilltop Securities. Really happy to be here today and present our credentials for underwriting services. Brittany, are you going to be able to pull up the presentation? Great. You all have a printed copy of the presentation in front of you, and then it will also be up on the screen. So, and I think perfect. Great. So we'll start with introductions. I have a team here with me, and we'll have each person come up and introduce themselves. But just starting out, again, my name's Lindsay Savdi. I have been with Hilltop Securities for almost 3 years. Prior to that, I started my career in public finance, which is bond underwriting for governments in 1999 in the Northwest. So I am a graduate of University of Washington. I've been in the Seattle area for most of my life. And in 2021, Hilltop Securities asked me to open up a new office for the firm in the Northwest. So it seemed like a great opportunity. And I jumped across the street from a different firm that I was at and planted our beachhead. And here we are, we're serving as financial advisor and underwriter to municipalities from the region. So Tyler, do you want to come up next?
Good afternoon. Thank you so much for having us. My name is Tyler Benson. I work with Lindsay Savdi in the Seattle office of Hilltop Securities. I joined Hilltop in March from RBC Capital Markets, also in the Seattle office. I'm local, live on Bainbridge Island, and supporting Lindsay across the Northwest in underwriting and financial advisory work for municipalities. And thanks again so much.
Good afternoon, everyone. Thank you for having me. My name is Bill Evans. I run the municipal bond underwriting desk at Hilltop Securities. I've been with the firm for almost 5 years now. I have over 23 years of experience all in municipal bond underwriting. And the type of things we see come through our desk are negotiated underwriting, competitive underwriting, and municipal advisory work. All those deals flow through our desk under my watch in Dallas. And I'll get into here a little bit on what that means for you and the direct benefit of all those deals that we get to see, and that information we provide and the expertise of the desk here as we move through the presentation. But thank you very much for the time and looking forward to getting the presentation.
Thankfully, there's not a height requirement. My name is Ted Chapman, Mayor, Council. Thank you for having us. Good afternoon. I am based in Dallas as well. I'm actually right down the hall from Bill. I've been with Hilltop almost 3 years to the day. I like to joke that I was paroled 3 years ago after serving a 21-year stretch at S&P doing bond ratings. Before that, I actually was a municipal budget officer for 5 years. My role will be to support Tyler and Lindsay and the rest of the team on credit-related stuff, bond ratings, strategies for achieving the best outcome possible, should we decide to pursue a rating, which I think is very likely. We'll talk more about the details in a moment, but some of the other things that we do to prepare you, because it's been a minute since you actually have been in the marketplace. And so we'll talk about how to prepare for that, how to talk to the rating agencies, what are they going to ask, what are they going to look at, what do they mean when they say this ratio instead of that ratio. So that'll be my role in this transaction.
Put the microphone back up. Sorry, Ted. On this first introductory slide, there's several people who are on the slide who are not with us today, but I wanted to take a moment and just point out that Hilltop Securities provides more than just financial advisory and underwriting services. We are a full service provider to governments across the country regarding debt related needs. So in the middle square there, we have Kevin Berry. He is one of our fixed income specialists. So what that means is he's somebody that could help the city with their investments on a short-term basis. So if you're buying, so some of your money is in the LGIP, if you have other money that you invest separately, he's somebody who could help you buy municipal securities or agencies or treasuries. We have Colby Jackson down in the corner. He is our arbitrage rebate specialist, and this is something that will be important to the city when you issue new bonds. Because you do have to track the interest rate that you earn on the proceeds from the bond issue. And if you earn too much money, you have to rebate it back to the IRS. So we have a team of people who can help with those calculations. We have an investment management team that can do longer term investment management for the city. And then we have a continuing disclosure team, which is another really important factor. When you have bonds outstanding, you need to file certain financial information on this website that's called EMMA. And that documentation has to be filed every year. And we have a team that can help you maintain compliance with making sure that all of that gets filed in a timely fashion. So before I jump in any farther here, this is not changing. There we go. Have any of you worked on bond issues before? I think Lisa has, and Troy, you have not. Are you familiar with bonds? I just want to make sure that we don't talk over your head. It's really easy for us to get into a lot of lingo. Do you have any familiarity with bonds?
Only ones that they'd already established
Okay.
when I was
Okay.
on the council. So
Okay, great.
that was a long time ago.
Sure. Okay, well, please feel free to ask any questions that you have. We really want to make sure that this is informative and helpful for you. So we'll just start out with what we believe our competitive advantages to be, and we'll talk about these high level items and then dig in more throughout the course of our presentation. But the things that separate us from our competitors, first off, our experience with cities nationwide and locally. We've been in the business for almost 76 years or 77 years working with governments on their municipal financing needs. So we have a long history of looking at a variety of types of transactions, and we can bring all of that background to bear to the city. We have expert insights from both Moody's and Standard & Poor's, given our credit specialist like Ted, and he's going to talk more about credit rating strategy for you. We have teams of people that work on different types of credits. So we don't do just plain old municipal finance for a city, for example. We work on housing issues and hospital issues. And while at the front, it might not seem like those transactions would be relevant to you, they really are, because it gives us insights into the different operations of these entities and how it might impact cities. Understanding the council goals is going to be something that's really important to us. We know that you need to borrow money for this facility, but we need to really understand what future borrowing needs you might have and how borrowing money for this issue is going to impact any future borrowings that you might do. Again, skill in funding a wide variety of public improvement projects. Again, we bring a full team to the table so we can learn from each other and make sure that we're giving you the best of the best in terms of what's out there for structuring ideas. And then finally, team approach. We never work individually here in the Northwest. Both Tyler and I are here. We stay in very constant communication every day about what we're working on for our clients. So if one of us is on vacation, there's always somebody to back us up. And so you'll never be waiting for a phone call because of our schedules. So just a little information about Hilltop Holdings, which is our parent company. So Hilltop Holdings, as Bill said, we're headquartered in Dallas, Texas. Our holding company is a publicly traded company. Our stock is somewhere in the mid 30s per share. Hilltop Holdings is composed of three companies: Plains Capital Bank, which is a retail bank that's entirely in the state of Texas; Prime Lending, which is our mortgage brokerage arm; And then Hilltop Securities, which is where we sit, where we do municipal finance. We offer clearing services. We do not-for-profit finance and other types of securities-related work. We have offices in 40 we have 40 offices in 16 states. So you can see that a lot of our offices are located in the Southwest, which is the South and the Southwest, which is where our firm started. But over time, we've been able to expand into other parts of the country. Recently, I don't know if you've heard, but there have been several Wall Street firms who have closed down their public finance business entirely. And we've been really lucky to hire some of those employees. So we continue to grow our footprint. We are very much in a growth mode where a lot of companies right now are contracting. I've already talked about this, just that we do offer a wide variety of financial solutions for our governmental clients. So not just underwriting and financial advisory, but as we talked about, we have the arbitrage rebate, the continuing disclosure, investments, and other services. Again, we want to be a full service provider to our clients. We don't want to just swoop in and do a bond issue and then you never hear from us again. We really consider ourselves to be an extension of your staff and in regular communication, even when there's not a bond issue. So in terms of drilling down just a little bit more into the work that we do in municipal finance, we are the #5 ranked national municipal investment bank. So when you look at the work that we do as a financial advisor and the work that we do as an underwriter, we're in the market on average 18 times a week, which means we are seeing a lot of different types of deals. And Bill will talk about this in more detail just in terms of what that means when he's trying to figure out what the interest rates on the city's bonds should be. But having access to information, talking to investors every day, seeing these deals every day really allows us to hone in on the best structure and interest rates for the bonds versus any other firm out there. And then even bringing it a little bit more locally in terms of the experience that we have in the state of Washington. The chart over there on the left is national. We're the #1 provider of financial advisory services to cities in the country. But on the right, we've included a list, and this shows how old I am because this is the number of cities that I've worked with in the state of Washington since I started in this business in 1999. So I've worked with some big cities, some small cities. I understand the laws in the state of Washington and what that means for your financing. It's a really important aspect in making sure that your transaction goes as smoothly as possible. On this slide, we included some of the recent issues that we've worked on from a competitive sales standpoint. So these are bond issues that have come to market where we have placed bids and been the lowest bid, which means we've had the lowest interest rates on the bonds. You can see we've recently purchased issues for the city of Edmonds, the city of Richland, city of Shoreline, city of Tacoma, and we just bid on an issue for the city of Federal Way that came out a couple of weeks ago, and we lost by 0.001%. So just the tiniest of fraction, we came in second place, but anyway, we're really proud of the work that we've done for cities in Washington, and we continue to commit our capital to helping cities across the region with their financing needs. This slide, I'm not going to spend a ton of time here just because I think it really dives into the weeds, and I'm happy to go as far into the weeds as you want, but this is just a high level overview of the scope of services that we provide. So as I mentioned, as an underwriter, we start at the very beginning with helping you figure out, your outstanding debt, which you have very little outstanding debt at this time, but we look at what your future debt needs are going to be. We help you structure the bond issue, which means figuring out how many years you want to pay your debt service back over, working with the credit rating agencies to get your credit ratings, and Ted will talk more about that, but to get your credit ratings up to speed. Coordinating with other service providers. So we work very closely with the city's bond counsel firm and with others who will be involved in the transaction. We'll work with bond counsel to prepare the offering document, which is the document that goes out to investors. This is called the official statement. So we work very closely to make sure that all of the information that's in the official statement is correct and that there are no material misstatements or omissions. And then we work with you, obviously, to price your bonds, to sell your bonds on the day of pricing. And that's where Bill gets very involved in honing in on the interest rate that is going to be most advantageous for the city. And then, as I said earlier, we provide ongoing services. So that's kind of a high level overview of Hilltop and who we are and services we provide. Before we hand it off to Bill, do you have any questions, just big picture about Hilltop? And I know we can leave time for questions at the end as well.
Any questions? Eileen, you're small, so let me just raise your hand if you.
I'm small. Okay, thank you.
Your little box is small in the corner.
I
so-
know. I'm sorry. Thank you.
All right, I think we're good.
Okay, great. So Bill?
I think just picking up on this slide here, this is something you're going to have to do when you bring a deal. You're going to have to work through these 7 phases with whoever you choose. Hopefully it is Hilltop Securities, but what I can tell you is we have the team and the personnel to hold your hand and guide you through these phases every single step of the way. That's what our expertise is. And I think it's what Lindsay was trying to convey, or I think she conveyed very well, is that you have a well-staffed team. You're going to have Tyler and Lindsay right here with you day in and day out. That's going to be your day-to-day contact. As you get through step 4 and into step 5, we're going to bring in Ted here, really work with the rating agencies. And again, hold your hand, kind of walk you through this process and really help you understand what they're looking for and what everything means. This isn't the easiest business to kind of walk through as you're getting through these phases if you're not in the market as much as, say, we are. We're a programmatic issuer who's in 3 or 4 or 5 times a year. So having people that can walk through these phases, I think, is going to be extremely important. Phase 6 is where I come in. And that's one thing I just wanted to touch on as far as being an underwriter. So when it's time to actually market your bonds, sell your bonds, price your bonds, I'm going to be the person you're talking to. I'm going to be either on a Zoom call with you or sitting across the desk from you and walking you through the process of what the market is doing at that time, making sure you understand what's going on with not only your coupon structure, but your interest payments, your yields, and how that is affecting the total pricing of the deal. I'm going to go into as well as who's going to be buying your bonds. The Vanguards of the world, the BlackRocks of the world, to individual retail mom and pop investors. So again, from phase 1 to 7, we're going to be with you every step of the way and making sure you understand exactly what's going on. We know you take this very importantly. You take this extremely importantly as well. So as an underwriter, when you're looking at the services we provide here, we like to say that we're extremely experienced, reliable, timely, and respected. Again, the things that flow through the underwriting desk at Hilltop, I mean, negotiated underwriting, competitive underwriting, and municipal advisory. When you combined all 3 of those, I think there's only one other firm that's out there right now that sees as many transactions as we do on a daily, weekly, monthly, yearly basis. So because of those things, we have experience talking with other underwriters and understanding what's going on in the marketplace because we are in the market so much. We have reliable information because we're making competitive bids every day, talking with buy-side customers, and using our own capital to support our issuer clientele. Our information is timely. As mentioned, being in the market at least 18 times a week, as Lindsay mentioned before, the information that we get, we are not pricing Thursday's deals based on Tuesday's information. We're pricing Tuesday's deals based on what's going on Tuesday in the moment at that time. Not a lot of other underwriters have the ability or privilege to do that because they are just not in the market as much as we are. And again, that makes us respected. Right now, we're the number 8 underwriter, competitive underwriter, nationally in the street. If you go from 2021 to 2024, we're the number 1 Washington competitive underwriter that's not a bulge bracket bank. So take out the B of A's, the JP Morgans, the Morgan Stanleys of the world, and you add in all the regional firms. We're the number 1 regional firm in the Washington competitive market, which is one of the slides that Lindsay had up before on some of the competitive deals that we won. So we put our capital to work. We make sure that we support our issuer clientele, not only in the competitive market, municipal advisory side, but also the negotiated underwriting side as well. And I can tell you, we're willing to put our capital to work on the competitive underwriting side, and you're willing to hire us on the negotiated underwriting. You go to the top of the list, top of the chain, where we definitely put our capital to work. for our negotiated clients. Talking about distribution, you heard me mention names Vanguard, BlackRocks of the world. Those are going to be your tier one institutions. Anyone you talk to about doing your underwriting is going to cover those tier one institutions. We all cover Vanguard, we all cover BlackRock, we all cover Franklin Funds. Those are going to be your big bulge bracket buyers who are going to buy your bonds. But they're not going to be the differentiators when you're selling your bonds. They're not going to be the ones that are going to get you your absolute lowest TIC or all-in borrowing. As you move down the line, those tier two and tier three investors are going to be the ones that differentiate an underwriter from every other underwriter on the street. I can tell you we have substantial investment in those smaller tier two and tier three investors that not everybody on the street covers. So anyone you're talking to about doing your bonds, they're all going to cover the tier ones. Not only do we cover the tier ones, but we made a substantial investment in making sure that we cover as many tier two and tier three investors out there. What does that mean? As we're pricing your deal, maybe you can build a book of business of 2 or 3 times subscription while adding in those tier two and tier three investors. We're hoping we get a subscription level of 3 or 4 times subscribed for. And in general terms, what that's going to do, it's going to lower your all-in borrowing costs. It's going to be a direct benefit to you, not only to the investors that we can distribute the bonds to, but your cost of borrowing on the deal as well. We have retail investors. So as we mentioned before, we'll kind of walk you through all this as we're talking about pricing. We'll tell you who your tier ones are going to be, who your tier twos are going to be. We have a wealth management group that has a retail investors. We'll tell you how many mom and pop retail investors are going to be supporting your transaction, and if any of those are here in the state of Washington as well. And then we have exclusive distribution platforms that are a little bit away from us, but are still involved in our deals. Some of these include working with local banks, regional banks all across the country, looking at their balance sheet, their cash flows, and as we recognize that they have room to add municipal bonds, you can put municipal bonds into their portfolios as well. So again, we have a well-rounded distribution platform. It's not about just pricing the deal. It's about executing a distribution as well. You got to make sure you can sell the bonds for the buy-side customer. Want to talk about our capital position. We're very well capitalized. As mentioned, we're the number 8 competitive underwriter right now. Last year, we bid on over $19 billion in par amount in the competitive underwriting space. So think about a $30 million deal that you're thinking of bringing. We outlaid about $19 billion supporting our issuer clients. We would love the opportunity to use our balance sheet to support you here at Tumwater, 30 million, 60 million, whatever it may be over the course of a period of time. But we have the balance sheet in order to support you, and we have a track record of supporting our issuer clients. Here's some of the examples that we have. I know it's a little tough to read here. You have the date of pricing on the left. You have the par amount of the deal size. Then you have the name of the issuer. You have our liability at Hilltop, how much we are supposed to be underwriting if there's a balance. So if you have a $10 million deal, there's a balance of 5 million bonds. We should be underwriting 2.5 million, 50% for a 50% manager. And over to the right, you can see how much we actually underwrote. And then we have the ratings as well. But just to show you in volatile markets, since COVID, I'm sure everyone follows the stock market, everyone follows treasury market to a certain extent. It's been extremely volatile. There's a lot of ups and downs. But what I can tell you is we are here to stay as far as supporting our issuer clients. As you read down that list, the one on top, we underwrote or we supported 57% of the client's bonds. As you move down to the middle on the Spur California Rands, over 50% of their deal, we underwrote. San Bernardino, towards the bottom, we underwrote 100% of the deal. Those are volatile markets. And if you don't have a well-capitalized firm who knows how to evaluate risk and make sure that they're there for their issuer clients to support their deals, such as we're outlaying here, you're not going to have certainty of execution. One of the biggest things we want to do is not only do a great job of pricing your bonds, but we want to provide to you certainty of execution. So when you do come to pricing, and we are witnessing a volatile market, you know that you're going to be leaving there with a deal in hand and not working with someone who's not going to underwrite your bonds and not support your deal with the capital and tell you, let's try next week or let's try a month from now. We know when you come to the marketplace, you're trying to get a deal done. And we want to make sure that we will always provide certainty of execution for our customers That's what we want this chart to show you. Doesn't matter if it's a volatile market. We're going to make sure we put our capital to work to support our clients and make sure they leave with a deal.
Michael, Councilmember Althauser has a question.
Thanks. I just, just sort of a baseline question in terms of the definition of the term bonds underwritten. Like just looking at the top line, it's 57% underwritten. Does that mean that they were seeking a bond of $9.7 million and were able to secure 57% of that? Is that an ongoing percentage that you sell
So-
more portions of it over time, or
So Sam,
educate me at like
Yeah,
101
absolutely.
level?
I think it's a great question, absolutely. And I apologize for maybe brushing over this too quick, but San Perlita ISD, just use that example, was issuing 9.7 million in bonds.
Mhm.
We entered into the marketplace. The market's been extremely volatile. We were able to sell about 43% of the bonds. So 57% remained unsold on that deal after we ran an order period. So instead of telling San Perlita, well, you're just going to have to issue a deal of 4 million instead of 9.7, or telling San Perlita, let's not do this deal today. Let's come back when the markets are more stable. We told them, no, you're leaving here with a deal today. We will take that risk. You leave here with your 9.7 million. We take the risk of the bonds that we couldn't sell. And now we are at risk for those bonds. If the market falls off a cliff tomorrow, San Perlita is not at risk for those bonds. Hilltop Securities is. So we put our capital that we have at risk by underwriting those bonds. So if you go to San Bernardino down below on May 17th,
Mhm.
we entered, that was a non-rated deal. They needed 3 million in par amount, just under 2.9 million. We had buyers saying, you're pricing this deal too rich. We'll take your 3 million bonds, but we want them 25 basis points cheaper. The market was a mess, but it wasn't the right thing to do for San Bernardino.
Mhm.
What our buyers were doing was saying, we know the market's a mess. The buyers want the bonds as cheap as possible, right? So they run bond funds. So if you have $1,000, you want to buy a Vanguard mutual fund, and you want to buy a Vanguard municipal bond mutual fund, the cheaper Vanguard can buy the bonds, the better for everyone who's buying their mutual funds. It's a better return for them.
Mhm.
So instead of selling all those bonds to, it wasn't Vanguard, but let's just say Vanguard, 25 basis points cheaper, which is where they thought they can make a lot of money. We said, no, we'll underwrite those bonds 100%. We will go at risk. We are not going to cheapen up the scale to that extent just to get bonds out the door. Was not the right thing to do for San Bernardino. So we took that risk on at Hilltop. So that's why this, having $1 billion in underwriting capacity to support our clients, is so important.
Mhm.
And you may see other firms who tell you that they do this or they have this, but are they willing to utilize it?
Mhm.
That's what we're trying to show you on this slide.
Okay.
Time and time again, we take that $1 billion that we have in capacity to support our issuer clients and we put it to work. We want to make sure that when you come to do a deal, that you leave with a deal. And not just for half the money you're looking for, or a quarter of the money you're looking for, every single penny that you're looking for get, we want to make sure that we provide you certainty of execution. That's what every one of these deals shows. Not one of these have we lowered the par size or
Mhm.
told them to come back on another day. That's why this is so important. And this slide is pretty important showing that as well too. So everything we showed you before is on the negotiated underwriting. And you want me to just take a minute, the difference between negotiating and competitive?
Sure.
So negotiate is you hire us to do the city of Tumwater. We go through this process.
Yeah.
We walk you through every step here. And we negotiate. I tell you, here's where I can deliver your bonds. Here's your cost of borrowing. And you say, oh, I wasn't expecting that. I don't want that cost of borrowing. I wanted something cheaper. What can you do to get it cheaper? Tell you some things we can do. Again, I don't want to get too in the weeds. There's different structuring we can do that you may want to do. But then there's other reasons why you may not want to do that structure. It might give you lower cost of borrowing, but it might take away some optionality. But these are all things we can walk through step by step by step. But what I'm trying to show is you have options. In a negotiated process, you're going to walk through every single one of these steps. Me as the underwriter is going to be more heavily involved in talking with you about who's buying your bonds and what's happening. On a competitive process, you said we want to issue 30 million of bonds, and 11 o'clock on this day, everyone show me your best bid. So you're not technically hiring someone. People are showing you their best bid. And that's what we've done here. On all these deals, as I mentioned, we're number 8 in the country right now in competitive underwriting. The only firms that are ahead of us are bulge bracket banks and Robert Baird. A little different story, but anyway, that's what we've done here on the competitive underwriting side. And we want to show you is if we're willing to do that on the competitive underwriting where no one's technically hiring us, right? We're just showing the best bid. We're hired on a negotiated underwriting. We're certainly going to give 100% of our capital, time, and dedication for everything on that pricing. So negotiated, you're actually hiring the underwriter. You're working with the banking team, such as Lindsay and Tyler. Given you haven't been in the market in a while, walking through that process, I think is going to be extremely beneficial on the negotiated side of business. There's some risk with negotiated as well. I'm sorry, risk with competitive as well. If you decide that you're going to sell bonds Tuesday at 11 o'clock and the market's a mess and your bids are way out of favor, that's kind of what you're left with. On the negotiated side of business, you have a lot more flexibility, a lot more commentary with the underwriter about what's going on in the market. Maybe we shouldn't get in exactly today. Here are the risks associated with it. Here's what you think is going to happen. You don't get that commentary. You don't get that hand-holding per se. But when you go on the negotiated side of things, you're going to have Lindsay and Tyler from the day you hire Hilltop to the day of prices and after, walking you through every single step of the process the whole way through. So we want to show you we support our issuer clients competitive to show them that we know how to price deals and distribute deals and use our balance sheet. I want to show you that we have the team involved here to walk you through every step of the way when you're bringing a negotiated transaction. We have someone to walk you through every single one of these steps. And by the way, not everyone you're going to talk to can walk you through every one of these steps. We have the personnel to do. I want to show you because of how active we are, we're experienced, reliable, we know what we're doing. We have the distribution channels to distribute your bonds. For whatever reason, we can't distribute your bonds because of market volatility. We have the balance sheet and capital and are willing to put it to work to support you to make sure you get a deal done.
I have a follow-up question.
Oh,
Sure.
yeah, go ahead, Councilman Bergabi.
So you answered his question and walked through all the scenarios and assumptions. And earlier on, you mentioned that if I hear you correctly, what I thought I heard you said is that if on Monday or today, Wednesday, the market is at 25 basis points and the final underwriting is going to be on the 30th, which is next week, Friday, assuming that on the 30th of August, which is next week Friday, the basis point is going to be about 30, 35, whereas today that you started working on the project is 25. So is there a time frame which you say, okay, this is what I'm going to go by? Or do you have a drop date certain that you lock everything in place, kind of like you do in HELOC loan, and you say, this is what we're going by, and we're not going to go back to where we started from?
You want me to take that or do you want to? So when the process starts, they will walk you through the timeline on how everything goes. Once you're ready to get into the marketplace, I get much more involved. So once all the paper comes out, all the documents, prepare documents, phase 4. Once all those come out, Lindsay will sit down and say, okay, today's August 21st. All these documents are going to be out on the street tomorrow, August 22nd. We're going to plan to price your deal August 30th. Okay? I don't know, what's August 30th? Is that Thursday?
It's a Friday.
Friday?
Yeah.
All right, so it won't be August 30th, it'll be August 29th, Thursday. So we plan on pricing your deal August 29th. The papers come out. At that time, Lindsay and Tyler might get me on a call with all of you and tell you, your papers are out tomorrow. I'm going to send all of your documents out, your ratings reports that Ted worked on, your official statements, any of the documents you have with Lindsay and Tyler. And I'm going to get all that information out to all the buy-side customers that we cover. And I'm going to tell them, prepare yourself. We're pricing this August 29th. We're coming to market Thursday. All right, so I'm letting them know the time. They're going to take those documents and they're going to look at your credit. They're going to understand how much money you're looking to borrow, what's the credit backing the bonds, and also the date that we're pricing. And they're going to call us during that time period and ask any questions that they may have. Throughout that next week, we may have another call. And I may say, it's now Monday, we plan on pricing Thursday. Here's a mock scale. Here's where I think your bonds are going to price come Thursday. Okay? And Tyler and Lindsay will run numbers for you and put all that in dollar format. And then as we move through the week, I'm going to get some feedback. I'm going to talk to people and I'm going to lay out for you everything that might happen this week. There's inflation data coming out that's being announced. There's jobs data coming out. It could cause market volatility. We're going to get to Wednesday, which is the day before pricing. I'm going to lay everything out for you. Say, okay, I talked to you on Monday. Here's how the market has changed in the last 2 days. Here's how your number is looking now based on market movement. I cannot control the market, but my job is to navigate the market and get you the best possible pricing in that market. We have seen markets where they've been such a mess. Monday or Tuesday, we've said, let's pause for a minute and see how this works out. Those markets are March of 2020, COVID. Those markets are maybe sometime in 2007 and 2008 during the Great Recession, right? Otherwise, we're talking about pricing your deal in the current marketplace. Wednesday, I'm going to talk to you and say, I had a great conversation with Vanguard. I had a great conversation with BlackRock. Franklin Funds is not going to buy your bonds because of X, Y, and Z. I'm going to lay all this out to you. And then I'm going to say tomorrow, on Thursday, we're going to enter an order period. So all the feedback I got from all these buyers, Vanguard, BlackRock, Franklin, etc. Tomorrow, Thursday, for 90 minutes is your time to actually put orders in the book. Okay? Tyler and Lindsay are going to run those numbers. They're going to tell you how that looks. The next day, I'm going to come in. I'm going to enter into the marketplace for 90 minutes, let's say, somewhere between an hour and 2 hours. And then I'm going to come back to you again. And I'm going to say, here's all the buyers that came into your book. Here's how it looks. Good news, you were looking for 30 million. We have enough orders to fill 100 million, right? I know you're not looking for 100 million, so what are we going to do? Well, I'm going to lower your cost of borrowing. I'm going to take those yields and lower them because we are oversubscribed on the deal. We have too many buyers for the amount of money you want to borrow. So my job is to get some of those buyers to say they don't want the bonds by making them a richer for them to purchase. So they're going to evaluate. They're going to say, this isn't cheap enough for me to buy. It's too rich for me. I can buy other deals out in the marketplace right now that are much cheaper than what you're proposing for Tumwater. So that's fine. That's great. Because I have these other buyers to fill those bonds. It's a direct benefit to you because we're getting you a better price through that process. Does that make sense? Or so we're going to run that order period. And then I'm going to come to Lindsay and Tyler with a revised scale. Here's how much I was able to better your pricing based on the order book. And this is all good information that you're going to want. can guarantee you if you do hire us, what we're going to tell you is not only the best pricing we can get you, not only what happened during the order period and the feedback we got, sometimes knowing why why buyers aren't buying your bonds is just as important as to who is playing. Franklin's saying that they're not playing because Tumwater's only population of 25,000 people, they only play with 40,000 and above. That's something that maybe you want to know as you continue to grow. Could be for any variety of reasons. But I'll make sure you have all that information so that the next time you convene and people ask, well, why didn't this buyer play or that buyer? And who knows what kind of information people like to dig up. You have all that information on who played and who didn't play and how this was the best possible pricing. I'm sorry, did that answer your question as far as timing and how we walk through that process, or?
Yes.
Councilmember Swarthout.
Thank you, Mayor. So I think you probably, one of the questions I had was the cost advantage between the negotiated and competitive process. And so I think you explained that, but that was one of the things that popped in my head. And then the other one was back to your, to the screen that you had where the different places that cities or different places you worked. If you can go back to that one, I was just curious on we're gonna go back on the numbers, because there were some that you had that were, yeah, that one. So like on the ones for London, that there was only 60% or 75%, that was where you took on the liability. Is there, as opposed to the 100%. So I was wondering what would trigger something like that.
Sure. So HTS liability, if it's 100% liability for HTS stands for Hilltop Securities. That means that most likely we are the only underwriter on that deal. For London ISD, we were 60%. I'd have to go back and double check, but we most likely had a co-manager for 40%. So if there was 100 million bonds left, I would have to underwrite 60, and my co-manager should underwrite 40%. I can tell you in this case, though, we underwrote almost 10% of the deal. Typically, if we're not going over that 60, we just take down 100% of it. So we had a co-manager on that deal. That's why it's not 100%. There was roughly 10% of the bonds that were left after the order period. And we at Hilltop Securities underwrote those bonds. Does that answer your question?
Yes, thank you. And then the cost advantage is there a cost advantage between the negotiated and competitive process?
It depends. Either one can be cost effective in any different market environment. What I can tell you is when you're looking at par amount in the industry, about 70 to 75% comes negotiated. The balance, 25 to 30% par amount, comes competitive. So a lot more par amount that comes to our marketplace comes through in the negotiated process. When you go through a competitive process and it's a firm market or a good market tone, you have a lot of people fighting for your bonds. When that market tone turns, you have a lot less, trying to word it the right way, they're not necessarily fighting for your bonds. They're trying to put in a bid to make sure they don't take bad risk on a competitive market. That hurts you. So you kind of roll the dice a little bit based on market tone that's going on. And maybe that's a lot simpler to clarify pre-2020. But since we've been looking 2020 to present, what we've seen is obviously COVID, which has created market volatility, but also inflation, which has created rising interest rates and a lot of intraday market volatility. So it's one of the most volatile times that we've had in the marketplace. In general, in a stable market, competitive with a lot of firms fighting for your bonds, you get very strong pricing. Negotiated offers you that hand-holding experience, where if you're not in the market or have not issued bonds before, you have a team of people such as Lindsay and Tyler as your day-to-day contacts to walk you through everything. And again, depending on the market, it gives you a little bit of a sense of comfort. If you are hitting those market volatility days, you have an underwriter that you're talking to as well that can give you guidance in that market, i.e., this is an extremely volatile market. Why don't we wait a day? Why don't we wait a couple hours, for this to settle down? You have a variety of different options when you come negotiating. You have a team of people working with you, guiding you through the process.
Did that answer your question, Councilmember
Yeah,
Swartz?
thank you. Yeah,
Great.
good, thank you.
You can tell we don't do this often.
No, I think the questions are great, and I appreciate in doing this every day. I can move quick, and I appreciate the questions because it allows me to kind of make sure that I'm being thorough and making sure everyone understands the process. Because again, what I want to convey is having this team of people, we want to make sure that you're comfortable not only day of pricing with the price you're getting, but we want to make sure that you're comfortable with the whole process. 25, 30, $35 million is a lot of money. And we want to make sure that as you go through this process, we're not just looking at this as, well, whatever, I just bought a $50 million deal or a $10 million deal. We take this very serious. We pride ourselves in actually going the extra distance and making sure that we walk everyone through these steps, and we're staffed appropriately to make sure that everyone's comfortable with what's going on. And if there's a part of the phases that we talked about where you are not comfortable, we want to make sure you stop us, such as we're doing right now, and ask questions. There's no dumb questions when you're getting ready to borrow $30 million and you don't understand. We want to make sure you understand. Absolutely. And then here, I'm probably taking a lot of time, but just some of our other experience. GEOs, higher ed, or general obligation school districts, higher ed, healthcare, utilities, toll roads, lease revenue bonds, cruise terminals. These are all deals that we've underwritten at Hilltop. Anything from non-rated to AAA rated. We'd love the opportunity to work on a deal for City of Tumwater to add to our tombstones here. Before I hand it off, I know I've gone pretty long, but again, I just want to make sure, as everyone understands, any other questions about the underwriting process that maybe I can? Well,
Thank you.
Thank you.
So I know we have about 15 minutes left. I want to make sure that we have time for questions from you all toward the end. So I will be relatively brief. I want to make sure there's a lot of time for Ted as well. And just to put a fine point on everything Bill just said, the negotiated process can be really beneficial in sort of volatile markets where we get to talk with Bill on a daily basis about your specific transaction. Bill is one of the best in the business. He didn't say that himself, but he is one of the best in the business. I was just remembering when I had lunch with Troy and Shelly. Shelly asked me why I came to Hilltop a few months ago. I told you I joined Hilltop in March. Why did I join Hilltop versus one of the more, regional local firms? And it's because of the quality of the team at Hilltop. These are some of the best people in the business. Lindsay's one of the best in the business. Bill is. Ed certainly is. And serving them in the military, I was just acutely aware of having a great team and how critical that is to getting the mission accomplished, right? So when we're bringing your bonds to the market, you want to have the best possible team. Just want to advocate for these three because they're pretty incredible. But just looking at the plan of finance for your 30 million maintenance and operations center, LTGOs, we took a look at your debt capacity, your AV history. This factors into Ted's credit analysis as well, but your AV history is very strong over the past few years. That feeds into your debt capacity. So your non-voted debt capacity based on your 2024 AV, 6.3 billion, is around 93 million of debt capacity. So your 30 million is well below that. There's no debt capacity concern here. We just wanted to kind of visualize that and show you the analysis behind it. This is a very initial look at how a structuring of your 30 million LTGOs would look. So if you were to sell these this year with current rates as of just a few days ago, And we added a cushion there of 50 basis points. That right table shows some of the preliminary statistics on what that would look like. So you're still below 2-1 repayment ratio, a TIC of, about 4.4%. And we just structured as level debt service. Again, very preliminary look. We'll dial this in as we get closer to pricing. It's another benefit of negotiated underwriting, so we can tailor this tailor the structure to your goals, your needs, and to the market demand that's out there, especially when it comes to something like couponing. This is where we talk to Bill leading up to the pricing to make sure that we're going out to the market with interest rates that investors want to see. You can sell your bonds. And when we get closer to actually selling the bonds, we're going to go through a process called pre-marketing. This is unique to a negotiated underwriting process that gives us a chance right up front to go out and talk to investors ahead of time to build demand, enthusiasm, interest in your bond issuance for the city of Tumwater. There's going to be a little bit of investor education because you haven't come to market since 2011. And when we go through the rating process, hopefully I think Ted's going to go through it, but those 2011 bonds, AA minus for your golf course. And hopefully we're going to be looking at a AA plus or in that range. And we want to tell that story to investors in the pre-marketing phase. And so we sort of look at this in 3 phases, phase 1, 2, and 3. Typically, we want to first contact current bondholders, which is not really applicable here. But then we look at who are the investors who are buying similar paper out there in the market. So other cities in Washington that are in the AA category, LTGOs, who are they? And you can see a list of the top holders as of today, as of a few days ago, out in the market. We want to talk to them. And then who is out there in the broader U.S. market buying city credits, AA rating category, LTGOs, who are not currently in, a large player in Washington. We're going to call them too. So a lot of outreach goes on beforehand to try to, again, build that interest in your bonds. One big advantage of Hilltop as a national underwriting firm is that we have broad and deep relationships with these bondholders, with these investors out in the marketplace. We're very active in the secondary market and competitive bidding, as Bill talked about. Over the past almost 3 years, so since early 2022, we've facilitated $2.2 billion in Washington bonds in the secondary market. That's over 4,000 trades since then. So we're very active, and we're one of the top competitive bidders in Washington State. Bill, did you want to say anything else about that?
Oh, Councilmember Swarthout, the yellow hand on the yellow background doesn't show up very good.
Oh,
Sorry.
Thank you. So, sorry, I keep having questions, but back at the other screen, it's just like the whole part about debt capacity. So I've never done this before. So no, the other one I was looking at, so the maximum amount of debt service. So if we're borrowing or doing the $30 million in bonds, then it would be $1.8 million is what it would cost the city of Tumwater. Is that what that means?
Oh, debt service.
That one, the maximum annual debt service.
Oh, here.
Or annual basis. So you pay $1 million every year, or what does that mean?
Right. Great question. Great question. So these 3 lines right at the bottom of the table: total debt service, maximum debt service, and average. Your total debt service is the total principal and interest that you're going to pay over in this case, 30-year period of the bond repayment. The maximum is your maximum in any single year, and you'll see that it's extremely close to the average because we did it as level debt service here. So maximum and average are nearly the same. If it was exactly level, they'd be exactly the same number, but there's going to be slight differences. Does that answer your question?
Yeah, thank you. And then the other one, there's been sorry, I had to put this in a question. Like with the state, with their 401k program, with they they want to, there are concerns with who they're borrowing through or who's part of that whole plan. And so, we'll get comments about, they don't want to support, petroleum companies or things like that. So I'm wondering I don't understand the bond part of it. What makes up of these bond, or you have different groups that are part of this bond thing and they have different funds that make this up. So that's, I guess, from a standpoint of being transparent with our community, I'll just, as far as who we're investing with. And I think that may be a question that comes up, so.
Yeah, so are you kind of referring to the names of the buyers that we have on the bottom of this page here?
Right, because like Vanguard Group, that must be, not just bonds, I'm not sure how bonds work. And so that's why I was wondering what makes up that bondholder group for Vanguard and.
Right. So let me back up a little bit here. So that's exactly right. Vanguard would be the ones that we'd be looking to sell your bonds to. So you think about it this way, Vanguard has a bunch of municipal bond funds.
Mhm.
Kind of cool, right? City of Tumwater bonds would be in a Vanguard municipal bond fund if they decide to play on the deal. So when let's just say you as an individual have $1,000 to invest, you want to buy a municipal bond mutual fund, you might go to Vanguard.com, look up municipal bond mutual funds, and invest your $1,000 with Vanguard. And that's what all these buyers are essentially doing. Vanguard is a mutual fund. Looking down, Auto Owners Group is an insurance fund. So they have insurance claims. So they take in all these premiums that they collect and they work out claims over, we assume we're going to have to pay out this much in 10 years, 15 years, and 20 years. And what they do is they buy municipal bonds that might have to match those claims. So you're not necessarily investing in auto owners per se, but they're an insurance company who has to take the money that they have on hand and invest it for a certain time period to make sure that they have that money on hand when it is time to pay those claims. So that's the difference in some of these funds. Most of these are going to be mutual funds, auto owners and insurance companies. State Farm, that's another insurance company. It's going to operate the same way as auto owners. Dimensional Fund is going to operate as a mutual fund. But you're right in the regard of try not to complicate it too much. These are mutual funds. They might run equity funds, right? Buying stocks. They might run corporate bond funds, buying corporate bonds. A lot of these run municipal bond funds. Well, where do they get their municipal bonds to create their fund? They come to places like Hilltop. They go to the new issue market. They buy bonds like City of Tumwater to put into their municipal bond fund in order to create a basket of municipalities that make up their municipal bond fund. Some of them might be state of California, meaning Vanguard has a fund that only has state of California bonds. State of New York, they might have one that's strictly state of Washington. I think there's a few that have Washington funds. So that's the difference between some of the names. You're going to see mutual funds, insurance companies. You may see something, or you may hear people talk about SMAs or professional retail. You heard me mention mom and pop retail. That's like any one of us who has a couple $100 and they want to buy a municipal bond. Or you might have professional retail. BlackRock, you can give your money to BlackRock and they'll pool 500 from you, 100 from you, 300 from you, and they pool everyone's money to buy municipal bond funds and then put it in the end users' accounts. But they essentially block everyone's small contributions up to buy a bigger block of bonds. Okay? So as far as what Vanguard is buying those bonds for, they may have any number of different funds that they put it in. What I can tell you is working with the buy side, they are extremely careful about ESG as far as what's going into their funds, environmental, social, and governance. So if we were issuing bonds for a private prison, chances are those bonds will not make it into Vanguard's funds because they don't want to use that money that all of you are investing in their funds to invest in something that maybe doesn't align with them socially or governmentally.
Thank you. That's good. Thank you.
Can
Does
I,
that answer your question? Or?
can I weigh in on this here real quick? So, Councilmember Swarthout, I think that, what I heard you describing is, as an investor, you want to be careful of who you're investing in. In this case, these companies are investing in the city of Tumwater. So we're the product. Is that fair to say?
That's correct.
So the city of Tumwater is the product that's being invested in this case. So we're on the flip side of the situation that you described where, if you're investing into the deferred comp program or whatever, and they're out in the market on your behalf buying investments.
Right.
We are the investment that they would be buying into, if that makes sense.
Yeah, that does. Yeah, thank you.
Thank you.
Councilmember Althauser had a question too.
Thanks. I don't know if this is best directed to yourself or to Tyler, but because we haven't been in the market for a while, which for us has been intentional, right? Because we've been trying to save funds and be diligent and financially prudent. But then there's sort of this re-education campaign that's required. It sort of sounds like it. Is being out of the market an asset in the sense that we're sort of demonstrating our reliability? Or is it a liability in that we are a small fish in a big sea who hasn't really played in the market in a while?
That's a great question. You want me to go for it? From what I notice in the municipal bond market, I think that if you were to bring your deal to market, you would get a lot of eyes on your deal. And the reason you get a lot of eyes on your deal is because you're not state of Washington that issues $4 billion a year every single year, $3 billion a year every single year. You're not one of these big cities. You're not the city of Seattle, who's offering a variety of different credits and a lot of bonds that all these funds are somewhat saturated with. You're a diversifier. You're in the AA rating category, right? You're a good story for them to put into their funds. So I personally view that we would get a lot of eyes from buy-side customers saying, I haven't had Tumwater bonds in 15 years, 10 years, whatever it may be. This will be great. I want to learn more. I want to know what's going on. I need to brush up on the credit. I see it as an advantage that you have not been in the market in a while. There's no market saturation. Now, don't get me wrong. There's deals that come every year. They bring a $50 million to $150 million deal, and they're great credits. And everyone looks forward to those deals coming because they are such great credits. But you're in a different category here. You are not a programmatic issuer where you're going to be issuing bonds every single year for hundreds and hundreds of millions of dollars. You're going to be on the other side of the equation where you're going to be in the market every several years on a smaller scale. And again, I think it's going to bring in buyers because they are not saturated with the name. And again, you're a fantastic credit. You're not this you guys understand how the rating categories work? AAA, AA's, A's. You're not this A3 rating that's, balancing the line of A3 and BBB or non-investment grade. You have a good story here. You have a good credit here. You've been financially prudent. These are all things that buyers like to look at.
So Mayor, if I promise to be very efficient and respectful of your time, am I okay to go a few minutes?
This is a very good education though, and I believe that this is being recorded, so I will encourage other council members who are not attending this meeting before we make decisions that they might want to watch this recording because we don't deal with this very often, and I would say most of us are not buying on the stock market that often, and so this is a good education. So thank you.
Very good, thank you.
What I would say is that, I'm sorry to interrupt, but any questions you have even after this, we know this is a short period of time for a lot of questions you may have. Please, we want to be your team and your partner. Please reach out. I think we'd all be happy to get on another conference call and answer any questions.
Great, thank you.
No worries, I'll step up to my short microphone. This is usually the part of the conversation where I will advise you to maybe top off your coffee. Sometimes if my wife says I'm having trouble sleeping, tell me about your day. But this isn't something that happens by accident. Obviously, you've been thinking about borrowing for quite some time. Here we are in August, maybe pricing in October, November. It's a several month time span at least. The rating agency portion of that is maybe 2 up to 3 weeks out of that entire process. I want to emphasize and assure you that that is not a 2 to 3 week stretch that we would just sort of be passively involved. Oh, we'll set up a calendar appointment in Outlook on behalf of the city and talk to the rating agencies. We'll be very actively engaged. And so what the rating agencies do, and maybe to put it in sort of a sidebar perspective, I'm not somebody that can just write a check to buy a house. I have to get a mortgage. And so I will talk to folks that will provide me a credit score, a FICO score. I don't know who Isaac was. I don't know if he was really fair or not, but you can think of the rating agencies as, Moody's, Fitch, S&P is sort of like Equifax, TransUnion, Experian. They will opine on the general likelihood that the investors in your bonds, the ones that Bill spoke to, are they likely to be paid back in full and on time at every payment period, which is typically every 6 months through the course of 20 to maybe up to 30 years. It just depends on the ultimate deal structure. So they will provide a rating report that will be used by the Vanguards and the BlackRocks of the world. And fair or unfair, they kind of boil your story down to about, I don't know, it's a tear sheet of maybe 6 to 8 bullet points, maybe a 2 to 3 page narrative that says, yep, here's where they're located. Here's their economic fundamental summary and their financial health, and here's their debt and so forth. And once upon a time, it used to be, I'm dating myself a little bit, but they're way back. There used to be a show called American Bandstand where the joke was, hey, it's got a good beat. I can dance to it. I give it an 88. And you're like, well, what does that even mean? So the rating agencies kind of got in a little bit of trouble after the financial crisis because they were viewed as applying these rating opinions kind of arbitrarily like that. How do you, the rating agencies, arrive at this particular outcome? Why aren't they all? If the default rate of municipal bonds is a fraction of 1%, and that's been proven out for like 50 to 60 years of data, why aren't they all AAA? That seems like an extraordinarily safe investment. So what the rating agencies do is sort of rank order and provide relative, there are some cities, I'm sure you hear this at WFOA and other professional organizations. There's some cities that are kind of scraping by. Maybe the fund balance is pretty weak. Maybe they've had trouble retaining a finance director because of retirements and ability to attract and retain staff. And they've got late audits and people are like, well, geez, I can't really tell the financial position here. I'm uncertain as to what's going on. So we want to be able to make sure, we, the rating agencies, want to be able to make sure to communicate to congressional scrutiny, among others, here's how you replicate that rating process. Here's what we mean when we, the rating agencies, say your particular financial ratio is this. Well, how did you arrive at that? What's in the numerator? What's in the denominator? So that's the kind of stuff that the rating agencies have now produced by way of scorecards. So they'll look at your key credit factors. And again, in general, it will be your economic fundamentals, your financial health, your debt and liabilities, and management and governance. And I'm not talking about stuff like the folks in this room, the folks on Zoom. Management and governance is more of an assessment of, do you prefer or maybe even have a policy to retain a certain minimum amount of fund balance, or well, okay, we've adopted the budget. Let's just throw it in the file cabinet and come back to it in 12 months from now. Well, no, nobody does that. I mean, staff provides monthly budget to actuals. They'll tell you what your investments are doing over time, maybe quarterly produce reports on that. Those are the kind of things that the rating agencies look at that maybe it's a little bit harder to measure, but still very informative as to credit quality. And so once upon a time, you had a rating that was in kind of that second tier. I think it was AA. The rating agencies, some use pluses and minuses to distinguish how high within that category you are. Others use numbers. They're just, well, this is our way of doing it. Ultimately, at the end of the day, it's kind of the same thing. If you get below that black line where it says speculative grade, maybe you've heard the term junk bonds. That's more synonymous with stuff that is a little bit higher risk. Generally, again, munis are not without risk, but they're extraordinarily low risk. And so what we do is be very actively involved in that process, because now with these scorecards, sometimes it's just, yep, we measured that, we checked that box. That is a disservice to what you do and how hard you work. Quite frankly, there is more to the story. Any number is just a number without context. That's where Hilltop will come in and provide a very active role in providing that context. And so from the point where you decide in that 7-step process, yep, we're going to be involved, we're going to get a rating. In the municipal bond market, in any given year, there's about $350 to $450 billion worth of transactions on average. Roughly 85 to 90% of those will have at least one rating on the cover of the offering statement. Now, some are small or a little bit more speculative, dirt bonds, development type stuff. Those are probably going to be unrated. The other 90% will have some rating somewhere in that rating scale with at least one of those rating agencies. And I think probably for a deal this size, we would probably be okay with one rating. I don't think that we need two, but that's stuff that we would be able to provide you as council members, the considerations of, we could go this way, we could go that way. We just want you to have the full information set. So again, you can be fully informed, as even again, that's only a 2 to 3 week part of the process, but we still want you to be fully aware of all the options.
And I'm sorry to interrupt, and this is actually very important stuff, but does everyone understand the impact of pricing as you move down the ratings, right? So the top one where the AAAs are, those are going to price better, right? You'll get a better cost of borrowing than if you were down where those A3, A-, are. So sometimes, as that's talking, just a notch getting you from AA- maybe to AA or AA+, could have a pretty big impact on how your bonds price in the marketplace.
Okay, that's exactly what I was going to get to. So, I mean, again, I think anybody can walk in here and tell you, oh, these rating agencies, they all use scorecards now. Anybody can walk in, any firm will say, oh, we've reverse engineered those scorecards. I promise you that Hilltop will be the only one that walks in here today and says, we have a guy that worked at a rating agency for over 2 decades, who built a scorecard, who built a rating model, and who essentially speaks the language, if you will. One of my roles to support Lindsay and Tyler is to take rating agency, sometimes it's gibberish and jargon, and provide plain English. Like, if you get a copy of the draft of the rating report and it says, oh, well, your available fixed cost ratio is X. Well, what does that even mean? Well, that's my job. That's my job, is to tell you in plain English, here's exactly what it means. But we want to get out ahead of that and provide a good rating strategy to get you that best rating, to get you that best possible cost of borrowing, because that's very material. If you can get a little bit lower of a coupon, that's that much less interest that you have to pay over 20 to 30 years every 6 months. So one of the three, this S&P is my old shop. This is an example of what a scorecard would look like. And again, they have sort of, the overall broad buckets, but it's stuff that you would assume would be pretty self-explanatory, because at the end of the day, if it's a limited tax general obligation, that means that the revenues are going to be being derived locally to pay your bondholders back on time and in full over the course of the life of the bonds. Well, so it certainly makes sense to inform the rating opinion. What are the economic fundamentals? Where do folks work? Are there a lot of people that maybe, because of the macroeconomic conditions, they're not working right now? How much do they make? Do you have, is it sort of like the proverbial factory town where if the steel mill closes up, what is everyone going to do for employment? Or we've got a really good, there's fantastic growth, as we already saw. I mean, I think that'll be part of the good story. But I mean, there are others, Rust Belt is a great example where they don't have the stuff that you guys can quite frankly brag about when it comes to economic fundamentals. Financial health, that's pretty self-explanatory. I know that you probably every budget prep session rather, you're talking about, well, we've got fund balance, rainy day reserves. Let's designate some for this particular project and put new HVAC on the senior center. Or, you know what, times are pretty good. We've had a favorable variance to budget. Let's sock away some money just in case. I know those are conversations that come up all the time, or at least maybe once a year.
So can we,
Yes, ma'am.
yeah, so
Absolutely.
we got a couple other items on our agenda, so.
I'm gonna zip through it. I'm actually almost
Yeah.
done. Now Moody's, same type of thing. they're going to approach it very, very similarly. I will tell you Moody's, there's pros and cons to each of them. Moody's is a little bit more bearish when it comes to certain assumptions, such as pension. They will sort of throw out, like, we don't care what the actuarial said. We're going to do our own assumptions as to discount rate and pension liability and so forth. They also look at it as a whole of government. So even though it is ultimately a tax secured pledge, they actually will take a peek at your enterprise funds, like the golf course fund, utilities, and so forth. I expect that they would arrive at a very similar opinion as to what S&P would. The Fitch scorecard, Fitch is a smaller market player. If you were only going to get one rating, I think Bill would tell you it probably would not be Fitch. It would be either S&P or Moody's. Typically, Fitch is a companion to one of the other big two. But at the end of the day, I think they would arrive at a very similar point as well, because there are just so many self-evident strengths here. We wanted to provide you, again, some peer comparisons. One of the things I do, and sometimes it has nothing to do with bonds, it might just be, how does our fund balance stack up against similar sized cities in Washington State? Where might other ratings be compared to ours? What are the rating agencies thinking? They provide research all the time. That's stuff that maybe you saw something in a trade magazine and you're wondering, what in the world does that even mean? Reach out to Lindsay. We'll make sure that you get that research in your hands. And then just to give you one last closing thought, the rating agencies, relatively speaking, have a lot of confidence in local governments within Washington State. Cities and counties are very highly rated. The typical rating here is just a little bit just below that AAA. And on average, that's about a notch or two higher than other states nationwide. And it just goes to show that, I mean, relatively speaking, conservative, low debt, some of that is constitutional, some of that is just good policies and conservatism, very strong reserves. And let's face it, the economy here for the most part is gangbusters. I mean, there's some parts of the state, maybe not so much, but certainly not here. Thank you very much.
Great, thank you. This has been extremely helpful. And it'll be a good resource for other council members as we get more into, 'cause we're more of a subcommittee for the whole council, so we get to kind of present all this to the rest of the council. So thank you very much. And I appreciate everyone coming for such a long distance too. Thank you.
It's like 100-something degrees in Texas, so this is probably
Yeah.
pretty nice, right?
Okay. All right,
Thank you, guys.
great. Okay. Oh, so we have another.
Oh, right now.
Oh, I got it. Oh, got it. Okay.
Oh,
So these are two different firms then?
Yes.
Okay. Huh?
We know how it works.
Right.
I'll just do a really quick introduction. This is Dave Tregesser from DA Davidson. And Dave and his company have helped us on our previous bond issuances, which, as you know, have been a lot. And I'll let him tell you about himself. Just a second. Great.
Great. Thank you.
Operate this corruption. Oh, thank you. Good afternoon.
Hi.
And thank you, Troy. As he mentioned, I'm Dave Tregesser, Managing Director with DA Davidson. And thank you very much for letting us visit with you today. I also have on the line my colleague, Maura Lentini, so I'll be asking her to introduce herself in a minute. And Brittany was nice enough to let me know that she's provided you with a handout as well of our presentations. So I will go through that and gladly answer your questions. First, I'd like to say I'm really glad to be here in Tumwater today. I started my career more than 40 years ago, and I worked for the state of Washington just up the road. Even though I now work in Seattle, I'm often back in Thurston County working with a number of clients. You'll be hearing about all that. So I've got my little resume on here. As I mentioned, I've been in the business a long time, 39 years in public finance, all specializing in local government, specifically city government. And we have a lot of city clients, both here in Puget Sound area, but also throughout the state. Highest priority for our team. You'll be hearing more about my team very shortly. They are the most experienced and talented group of folks in the public finance world. I've listed just some of the city clients here, but I'd also like Maura to introduce herself. You can hear me now. She's on the line.
Hi, I hope you can all hear me. My name is Maura Lentini, and I started my public finance career at Moody's Investor Service in New York. So I'm the rating guru for DA Davidson. That's really my specialty, is helping you through the rating process, helping you develop a rating strategy, reducing uncertainty about what the rating outcome will be, and of course, positioning the strongest rating case possible for when you go through that rating process. And of course, following through all of the report reviews, drafting the rating presentation, helping you with continuing disclosure should the rating change in the future, and things like that.
Thank you, Maura. So this page just shows you our finance team. As I mentioned, these are the most experienced and the most talented group that I've ever worked with in my career. Myself and Jim Nelson. Jim also has many years of experience, specializes in city finance. He's my backup. We work hand in hand throughout the state. We're both based in our Seattle office. Maura also is there, as you can see her under the column there. Suzanne Ada does all our quantitative work. I worked with Suzanne for 23 years, just exceptional what she does. We also have compliance, research, disclosure folks that I've worked with for many years. On the right, you'll see people that are in the pricing, the actual market making part of our department. Mark Furrow is the Dean of Northwest Municipal Bond Underwriters, and then some of his team. These folks are just part of the group that I work with. We are a nationwide company with fixed income throughout the US.
Yeah, that's my fault. Should be good now.
Thank you. So here are just some of our offices. Stars represent our fixed income offices. We are an employee-owned firm based in Great Falls, Montana. I was just there last week.
I'm from Montana.
Okay. Which makes us different from many firms that you may see. Being employee-owned, we're not subject to publicly offered and publicly traded companies' pressure to provide quarterly income and all that type of thing. But we are a large and growing company with 116 locations in 30 states. We're well capitalized, which will benefit you when we price bonds. We are a highly ranked underwriter, both nationally but more importantly in Washington, the leader for underwriting bonds. And we have a long history of doing so as a top priority for the firm. We take pride in our core values, which are the highest standards of business ethics for our employees, dedicated to delivering exceptional service to our clients. And I mentioned being employee-owned and how that differentiates us. But we're also are neighborly and support and participate in our communities throughout our history, which is 85 years. And our logo, of course, is the bison. I just listed some of our other qualifications. I mentioned a leader in city finance, a national leader, ranked 5th last year in the number of issues. Our commitment to the local industry, 89 years, and being employee-owned and based in Great Falls. I mentioned our ranking. Our national ranking here is on the top for 2023. We ranked 5th nationally. We did 220 separate financings. But more importantly, here in Washington, we are the #1 underwriter in the last couple of years, as you can see. We take pride in our city clients. These are a listing of our city clients throughout the state. And thank you, Troy, for mentioning our history with the city of Tumwater. It goes back to 1992. I've worked with the city for 32 years. Even though the city has not been an active issuer of bonds for many years, you do not have very much debt outstanding. In addition to these city clients in Thurston County, we have a strong commitment here. We work with 19 municipalities in Thurston County. In addition to, we work with the city of Lacey. I just met with the city today. You may notice their new police station, which is rising like a phoenix just north of City Hall. We're financing that. They're also doing some utility work at Lacey. We work with the city of Yelm. We work with the Thurston PUD. We work with many school districts and fire districts throughout the county. So you folks are very important. I've listed some references if you'd like them. These are longtime folks that my team has worked with. Roy at the city of Lacey. As I mentioned, I was just over there earlier today. We're working on 3 different financings for them. Cassandra at the city of Sumner. Importantly, they're doing a public works facility as well. And they'll be issuing about $30 million of bonds for that. City of Kenmore, don't even have that on the list, but they're financing a public works facility. We're working on that. Those bonds will be priced in the next few weeks, or rather few months. I've listed the city of Pasco here. They're the fastest growing city in the state with many infrastructure and financing needs. We work with them for a number of years. Darcy at the city is their finance director. And I also listed Dave at the city of Gig Harbor, just being another local client. Our history with the city. You can see it here on the far right. I've listed all the bond deals that I've worked with the city on going back to 1992. As you can see, more recently, you have not been issuing bonds, but that doesn't mean we haven't provided any service to the city. As you can see on the far left, we helped the city redeem some 2011 Gulf bonds to provide debt service savings. We worked with the fiscal agent and the city staff to do that. We always look at refunding candidates to provide net savings to the city if available. We worked with the city when S&P upgraded the city in 2014. You guys are a strong credit, and Maura will be talking more about that in a brief period of time. Also material events, postings to Emma, we work with the city on. I know Troy had some questions about environmental, social, and governance. We've responded to that. We periodically provide the city fixed income market and commentary reports to let your finance staff know what's going on in the local public finance market and nationally. And we respond to any other questions you may have. One was about habitat conservation and your continuing disclosure questions that may come up when you make postings to the website, Emma. Next, I thought I'd just kind of go over a couple Bond 101 type of comments. Just for a little background, why would you be considering debt for a project? Well, to gap the available cash on the project cost. You want to spread the cost over time so the people that will be benefiting from this will pay for it down the road. So it's quite common to issue bonds for long-term capital projects. It allows you to lock in the present cost of construction and eliminate construction cost increases. And sometimes it allows you to leverage other contributions to the project, whether it be state and federal dollars. Okay, now we get into bond and notes, the process for that. Typically, when we work with the city, we act as kind of the quarterback. We work with your finance team and put together a schedule, put together the folks that want to participate in it, and then drive that schedule to the completion date that you want and close the bond issue and provide you, wire transfer you dollars for your project fund at closing. So you've already gone through the process of identifying your capital projects, prioritizing your needs, determining what amount will be done with debt, what you can afford. I think I've even provided Troy and the staff with some preliminary numbers for the project to see the options for structuring the bonds. You decide on your final maturity date. Oftentimes we evaluate whether you want to consider any type of interim financing versus long-term financing for the project. If you're ready to issue bonds, you can size the bonds correctly. You feel comfortable about those numbers, then you can issue long-term fixed rate bonds and lock in the cost. As I mentioned, we coordinate with the finance team, which would be your counsel, disclosure counsel, and the credit rating agency. And then we put the documents together and coordinate the closing process to make sure that you receive your proceeds on time, and then evaluate how you spend those proceeds versus your draw schedule. With that, I'll take a break and introduce Maura to talk about the city's great credit and some factors that relate to it. Take it away, Maura.
Thanks, Dave. Okay, well, I did tune in at 4 o'clock, so I know you've just gone through this with the other firm at length. So I don't want to beat a dead horse. You know, as the gentleman said before, what we're interested in with your bond rating is framing your rating case so that you get the best possible rating available. And a lot of the rating is determined by things that are completely out of your control. What does the rating agency think of the economy? What does the rating agency think of Washington state law? And what are the wealth indicators in your community? Those are things you have no control over, and those are a big part of the picture. And then at the margins, there are elements like, what are your financial policies? What is your plan for fund balances for next year? What are the practices that you have for reporting to the city council? And how well does your team communicate with each other? What is your strategic vision? What is the strategic importance of the project? Those are all things within your control that we want to help you frame for going through the rating process. And it is a couple, 2-3 weeks of fairly intense focus on our part when we're serving the city. So the higher your rating, the lower your cost of capital. And that varies in the market from time to time based on market conditions. Sometimes credit, they call them credit spreads. That means the difference between two ratings in the market, how much interest cost difference there is. And that can change over time, depending on how sensitive investors are to credit at that moment. And but we know it's always better to get the highest possible rating. And the city currently does not have a bond rating. That's not your own fault. It's simply because the bonds that were rated matured. And so, but you had a very strong AA rating from S&P up until March of 2022 when those bonds matured. Previously, those had been upgraded to AA in March of 2014 when S&P adopted a new criteria. And again, that goes back to trying to take care of the discrepancy because municipal bond ratings were a little bit harsh compared to those in the corporate world. And that was justified when I was at Moody's by the fact that, well, municipal investors really don't tolerate risk very well. There's no upside for a municipal investor other than just getting paid in full and on time. And they're not going to get some kind of big return. The city of Tumwater is not going to kind of have a rally, you know, so they're not going to be able to sell their municipal bonds for, you know, a profit. They just really don't tolerate risk very well because they just need to know they're going to get paid on time and in full, reliably. So the ratings used to be harsh, but slowly Moody's and S&P have updated their criteria so that they're a little less harsh than they used to be and more comparable to what you see in the corporate sector. Can we go to the next slide? So you've done the hard work of determining what your capital needs are. You have various opportunities to invest your cash and your debt for the benefit of the city, and you've evaluated those and come up with a plan, and now you've got a project that you're getting ready to fund. That's a big part of the financing plan. Another big chunk of it is the bond rating and just figuring out what your cost of capital is going to be. That's reducing. We're trying to reduce some uncertainty by making assumptions that are reasonable about both the bond rating and the market interest rates, leaving some cushion in there. And then we do a lot of modeling. And that's Suzanne's role on the team, and Dave's just talking about, well, what kind of maturity structure really works best for the city? Do you want to finance this over 20 years, 25 years? Do you want to leave room in the future for additional projects? Do you want to have the debt service, start out kind of high and step down? And all of that is an iterative process that together we bring this into a financing plan that we can then bring to market. Can we go to the next slide? So you have just looked at a bond rating comparison recently, and the other gentleman was talking about a rating scorecard. I find that the scorecard is meant to make the rating process less of a black box, but fundamentally, the analysts are going to be looking at how you compare to your peer cities. And so that's what we've pulled together for you here is a comparison chart with peers. On the left side, we have Washington cities that are rated AA- and AA. And then on the right side, we have the AA pluses. And there's a lot of little lines here, various considerations, but I would like to draw your attention to two lines. The first one is the very bottom line, which is what I talked about before, the thing you have no control over whatsoever, which is these wealth and income indicators in your community. And one of the things that very, very strongly correlates with rating outcome is that wealth indicator. So for City of Tumwater, incomes are higher than the median, but not like exceptionally higher, but they are definitely higher. And the group of AA pluses here looks more similar to your wealth levels. That's what they usually refer to it as. And then on the right side, they're slightly weaker. They're more like just about average. And then if we were to look at the AAA group, we're seeing income indicators that are more like 150%. So that's one of the things that kind of makes a AAA out of reach, even no matter how wonderful your finances look. And I don't want to say it's completely out of reach though, because the city of Lacey does have similar income indicators, and they do have a AAA rating. And so we help them achieve that, but they also have, like, I would like to call your attention a little higher to just, I think it's about the fourth and fifth lines, which is the fund balance ratios. And Lacey is at 100%. They have huge cash reserves right now. And that is not really necessary. One could argue that, as a management team of a city, you want to deploy your resources. So it's not essential to get a AAA. And in fact, when I was at Moody's, we would often argue that, like, is it really AAA isn't like a grade that you get in school. You're trying to get the very best possible rating. Sure, we want a good rating, but you also want to use your resources to manage your city and take advantage of opportunities to provide services and build the facilities you need. So it's all in a balance. But right now, the city of Tumwater is looking very strong. You have great cash reserves and fund balances. You also have really good financial reporting. I want to call your attention to that too. The basis of accounting is accrual accounting. And a lot of these peers are using cash basis of accounting still. S&P is a little less sensitive to whether or not you have cash or accrual accounting. But the rating agencies really do like to see that more robust financial reporting. Finally, I would like to say that the city of Olympia is a particularly strong comparable for you, not only because you share a regional economy, but because of the similar size, population. There are a lot of characteristics in common. And the city of Olympia was only recently upgraded from AA to AA plus by S&P. Also fairly recent before that, their water and sewer utility rating was also upgraded. So we feel very strongly that the city of Tumwater has an excellent chance at a AA plus rating. And Dave was going to talk to you a little bit about whether or not you might be interested in issuing your bonds, the portion general obligation bonds and a portion backed by the utility. But we believe your utility rating would also be similar to AA plus or AA at the worst. Can we go to the next slide? Finally, the financial management. This is more the kind of the subjective area of what the rating agencies are going to be trying to analyze. And you have an opportunity in these months before you are going through this process to evaluate and look at your financial management policies and think about whether or not you might want to make any changes that might impress them, or just because you want to institutionalize the great things that you're doing. And a lot of the time, that's what we used to find very reassuring is, you know, this financial management team is amazing. They really have these great, you know, fund balance targets and practices, and they're very conservative about debt. But none of it is institutionalized. None of it is in the form of a policy. So should the management team turn over, we're not sure that that's still going to be in place when these bonds are still out 15, 20 years from now. And so the rating agencies love it if a strong management team like yours actually institutionalizes your practices in the form of policy. And of course, the converse side is that they really hate it when a city or a school district does not adhere to their financial management policies. And so I would encourage you to look at your policies, adopt ones that make sense, that aren't too constraining, because you don't want to get into a position where it's reducing your flexibility to manage the city. You just want to make sure that you are having achievable things that are in writing, so that should management turn over, some of your style of managing the city and keeping the financial condition of the city so strong can be institutionalized. And with that, I can turn it back over to Dave, unless anybody has any questions.
Do you have any credit questions for Maura?
Any questions? I think we're good.
Thank you. Thank you, Maura. As I mentioned, we provide a weekly municipal market commentary, and here's just a brief recap of what's going on in our market. You know, there are signs that the economy is slowing to some degree. You may have a lot heard about the Fed rate cuts that are both expected in September, or there's almost all market folks believe the Fed's going to lower rates in September and then even again in November. We think that will have a positive effect on our muni market. Talking with Troy, you're not expected to be in the market probably until the first quarter of next year. So a lot of that would have taken place. And again, Fed rates don't necessarily affect municipal rates to a great degree, because the Fed can only control short-term taxable rates. And you're going to be issuing most likely long-term fixed tax exempt rates in the market. So there's just a little trade-off there. I put some examples of the expectations in the market for those rate cuts in the lower right table. Types of non-voted bonds. So we have assumed that you're considering limited tax general obligation bonds, also known as councilmanic bonds, for this transaction. They're secured by your full faith and credit. They're issued within your 1.5% statutory debt capacity, and you'd be pledging your general fund to pay them back. But you could pay them back from a variety of sources, whether they be, you know, from the utility or other sources, whether they come from REIT, whether they come from any bank capacity, levy, lit, lift, any other revenue sources, they're available. Some cities are considering, especially for public works public works operations facility. For my project I'm working now with City of Sumner, they're going to be issuing about half LTGO bonds and about half water sewer revenue bonds. And it's allocated based on the use of the facility, you know, which departments are going to be at the facility, whether some of those would, you know, how much of those are from the utility. And so they made that decision to do that. We gladly go through any analysis you'd want to do any type of allocation if you wanted to do it. Or you could just decide to issue limited tax GO bonds. You've got significant statutory capacity to do so for the full amount, and then just pay it from different sources as you'd like. That would simplify things in some ways. There'd be only one bond issue rather than two. But there may be other considerations to talk about, whether you want to consider any utility revenue bonds. As Maura mentioned, your credit is strong on both sides, and we expect a strong AA rating for either of those if you decide to pursue either one. I mentioned your statutory debt capacity. It's shown here, some just from preliminary numbers. There are a lot of numbers on this page. I'll just direct your attention to the kind of the first banking under general purposes. I just assumed that you'd issue just roughly $30 million of bonds. I took that number out of the hat. And if you did so, you'd still have 64 million of statutory capacity under your 1.5%. And then they also deduct that from your total capacity, the 2.5%, which includes any voted bonds, which you don't have any. So you still have significant debt capacity. And the state also does an allocation for other voted bonds based on other uses like parks, open space, utility. We're not utilizing, those types of things. So significant statutory capacity. Again, that's just statutory, not your ability to actually pay back the bonds. You have to demonstrate to the market that you have the cash flow from those sources to pay them back. Maura mentioned some of the iterative process we go through. Suzanne Ada, my client, is our quantitative person. We'll run any number of models to evaluate options for this financing, whether it's 15, 20, 30 to 40 years. You're under state law, you can issue long-term bonds up to 40 years for this project. As noted there are trade-offs for any of these options. One, for the 15-year, granted it's the less debt service because you're paying it off quicker, but your payments are higher. It's like a mortgage. And then alternative 20 is the most standard for GO bonds, and then 30 to 40 can be done for projects as well. That gives you the lowest annual payment, but the highest total debt service over the life of the bonds because of the increased interest. Here's a snapshot of our muni market as of last week when we ran these numbers. And I just assumed that you need $30 million of bond proceeds deposited into your project fund at closing. And we looked at 20, 25, and 30 years. You can see the annual debt service estimates for these. 2.179 million for the 20, 1.816 for the 30 year. And then the total debt service for each of those options, the next column. And the true interest cost. In our market, true interest cost is kind of similar to an APR in the mortgage market, an all-in cost number. So as you can see, the shorter term financing, the lower the borrowing cost, but the higher the payments. So 382 was an estimate, and we assumed a conservative, as noted in that footnote, AA rating. We actually think your rating will be that step higher. And that was the market as of August 14th. If we get some follow through with the Fed and other actions and slowing economy inflation, by the time you issue bonds in early next fall or next, first quarter of next year, that may bode well. Just some more background. Here's the 20-year history of our market. This is called the Bond Buyer Index, a composite of general obligation bonds that are highly rated like you. You can see on the far right, the pandemic, where we were at all-time lows in the market for a number of years. Then we had that steep upturn. And now we can see that it's hard to see in the far right since this is a 20-year history, but rates have actually been coming down over the last few months, but still within the average for the 20 years. We further break this down into different maturities, 20, 10, and 1 year for each of these 20-year options for the high grade index. You can see that if you look on the bottom graph, this graph has gone up the most because this is the short-term rates. And if we expect the Fed to take action, again, that's a short-term rate. We'd expect those rates to go down maybe as fast as they came up, hopefully. Longer-term rates haven't gone up as much and have come down slower, as you can see that in the graph. I mentioned our role being kind of the quarterback to help this financing, work with the finance team to bring your deal to successful conclusion. Here's just a hypothetical timeline, key dates for working on it. Once you decide to move forward, you've decided on your project fund deposit, you've decided on your closing date, and you're essentially ready to go. It only takes about a little over 3.5 months to complete a financing. And at that date, you get wire transferred dollars to your project fund at closing, and you're ready to invest those dollars. And I did want to explain that municipal bonds are a little different than some other types of borrowings in that in muni bond land, you get all the proceeds at closing, long-term fixed rate bonds. So you'll get $30 million closing, and you get to invest those dollars over your draw schedule. We can help evaluate how that, what interest earnings you'd accrue and that. But you also have the ability to do interim financing via like a drawdown line of credit, where you just draw it as you need it over your construction schedule. That could be an option to consider too. The negative of that is that you have to take out the line of credit with long-term fixed rate bonds more in the future. So you're doing two financings, and you're taking interest rate risk, but you're sure of the amounts and the timing. So we'll go through all that stuff. But once you're ready to do a financing, it's about a 3-month period. The only action item for the council is the approval of the delegation bond ordinance. That ordinance comes before council probably about at least 2 months before we price bonds. So if you want money in March of next year, you need to approve a delegation bond ordinance like in January. That would delegate to staff and maybe the mayor the ability to finalize the transaction subject to certain parameters. They changed the law about 10 years ago to allow us to do this. Maybe it's been 15 years now. It all blends together. But before, we had to price bonds in the morning and then come to the council to get approval that night, which was really backwards. So finally, our legislature recognized this didn't make a lot of sense. And they now allowed cities to delegate the authority to finalize a transaction on the pricing day to staff and the mayor. So as I mentioned, that delegation ordinance will have a maximum par amount, a maximum maturity, it'll have a maximum true interest cost, and it'll have a maximum authorization period. So typically they delegate it for no more than a year. And there could also be a requirement in there to come back to council and report on the final issuance sale results to them.
Councilmember Althauser has a question.
Can you talk a little bit about your firm's capacity for underwriting, and if we don't get enough bidders on the bonds or enough sales on the bonds,
Sure.
and what sort of takes place from the firm's perspective in
Yeah.
terms of liability for that?
Gotcha. That's a good question. So when hiring an underwriter, you want to make sure that the underwriter is highly capitalized. In other words, they have the capacity to buy bonds. So the way a public offering works, just to kind of recap that first. So we pick a date and time in the morning. Typically it starts at 8 o'clock in the morning because we're dealing with a national audience.
Mhm.
And there's a 1-hour order period. Before that, there's a heck of a lot of work. But we get to that point, there's a 1-hour order period, and the underwriter, in my case, Mark, floats the bond out to the world. World comes back electronically with orders. Depending on the amount of those orders, and because we're working in the public offered market, just like a public offered stock, it's supply demand. Okay, we're in the capitalist system. It's all supply demand. So the higher number of orders, the lower the interest rate. So we go out with what we call an interest rate scale. It's 3.5%. Depending on what the market does. And before that, we've shown you all the comparables, all the other cities that have issued bonds recently in the last week, so you can see what results were. And because Mark works in this every day, and he's the dean of the market, he knows what to expect from the market because we're in constant correspondence with our sales guys. And so if we get orders of 3 times the number of 30 million, we get 90 million of orders, which is not uncommon. We just did a deal where we had $1 billion of orders for a $150 million deal. What does that mean? That means that the interest rates were too high. Okay. So we went back and ratcheted down those yields by 5 basis points, 10 basis points. These are small adjustments. Okay. Until we had an equilibrium, in the market where we have orders fall off, yields go down. Conversely, it can work the other way. You can go out in the market, nobody cares because the municipal market is not a perfect market. You know, things can happen, announcements, there could be a major war, there could be some other major economic announcement. And municipal investors are kind of like, they go to one side of the boat and then they run to the other side of the boat. And so maybe you don't have any orders. And so then you have to go back and reprice the bonds at higher yields and have a second order period. So, and then at the end of the order period, get to your question. Say we have a $30 million bond deal and we have $20 million of orders. Okay, that's close. You know, it's fairly close. Depending on where those bonds are, my underwriter, Mark, will come to me and said, Dave, the fair thing to do is to make this small adjustment, take the $9-10 million bonds into inventory, and we'll resell those bonds and finalize the transaction with the city, give them $30 million. Now, we have, as I mentioned, I've been doing this a long time. Mark's been doing it a long time. We've had numerous situations where we're either oversubscribed or undersubscribed, and we make adjustments. But our firm is highly capitalized. Municipal finance, because we are set up the way we are, is a high priority within our firm. They made the commitment to, you know, essentially lock in bond deals and finalize the transaction. But I'd be glad to provide you other examples of recent deals that, you know, where we've taken, we call that taking bonds down into our inventory that are not sold, and then we resell them. We have a reasonable expectation that we can sell those over a short period of time. That's what that's the role of an underwriter, is to buy, resell. We do keep a certain stock of bonds in our inventory for our customers on a daily basis too, but most of it is to buy and to resell. Did I answer your question?
Yeah, thank you.
Okay. Well, it wouldn't be a program if I didn't talk just briefly about federal tax rules. So your bonds, because they're governmental purpose, central purpose for your projects, you can issue tax exempt bonds that are rather than taxable. That's the good news. It's subsidized, you get a low interest rate, that's great. But you'd have to comply with the federal tax rules. Here are just three basic ones that you need to be comfortable with. Number one, when you issue bonds, you have to have a reasonable expectation you can spend the proceeds within 3 years. That's typically not a problem. Most people can spend the proceeds earlier. Now, if something happens, say you get in the middle of a project, you find Native American artifacts and you'll get, you know, you got to put things on hold. You know, that's not your fault. And you can't get the deal done within 3 years. Then you essentially need to, what we call yield restrict the earnings and your proceeds to the bond yield, that average yield that I talked about. Right? But you complied with federal rules because you had that reasonable expectation. Now, if the city can comply with a couple what we call 2-year spend down exceptions, you can keep what we call arbitrage earnings. I'm not sure if you've talked about this before, but if once we get the draw schedule from your public works folks, they can spend the proceeds. If it can be done in 2 years, there are 6-month intervals that we check. And if you can meet those spend down percentages, you can also keep your arbitrage earnings. As an example, you issue bonds at, going back to my other slide, at 25-year deal, 414. What's the state pool yielding today? North of 5%. So if short-term yields stay high, you can keep that addition to 4%, 4.14, you can keep it up to 5% if you could earn that amount during that draw schedule. So a little incentive there, which keep your project costs down, because you get to use those extra interest earnings for your project. Okay, so we'd run all that with your bond counsel, make sure we're all comfortable looking at those scenarios, see if you could comply with those, and then run numbers to show you what your expected earnings, incremental earnings could be. Okay, now the other thing that would be in that delegation bond ordinance, and this is a requirement, everybody has to do it. You have to comply with the EMMA continuing disclosure requirements. And that's the electronic marketplace, as we call it, for muni bonds. And so what that is that there's this electronic marketplace. You're required to submit your financials and also submit any material event that occurs. And the reason for this is that back prior to 15 years ago, municipals were unlike kind of the corporate world. Corporate world, they had to do all this reporting and stuff, but munis didn't have to do this continuing disclosure stuff. So the federal government said, you guys have to do it. And we have a disclosure specialist that works with our clients to help do it. It's not very burdensome. You just need to get set up on their system and then annually submit your financials. Typically that's done by the end of September each year. No big deal. And they don't come get you and put you in jail if you don't do it, but it is a requirement, and it has to be noted in your offering documents for like this issue. Have you been compliant with your past continuing disclosure responsibilities? That would be one question. All right, any questions on any of that stuff? Okay. We're at the wrap up, so I promised to get you out of here a little early, I think so. We are the #1 underwriter. We have a huge commitment to city finance. We have a huge commitment to the city. You guys are a very important client. It dates back 32 years. We serve the largest number of folks, and our company has an extreme commitment to municipal finance. I was just back in our corporate headquarters this past weekend, meeting with the chief executive, and he is fully endorsing all our muni work because he sees it as a core part of the business. So with that, I'd be glad to answer questions you may have, and that's our corporate logo.
Any questions? I'm glad we're not doing a test after this. Because that's a lot to
Yeah,
absorb.
I'm
So-
sorry.
No, it's good because we need to fully understand this so that we're very, so everybody knows what kind of decisions we're making.
Yeah,
So
well,
this
what
is very,
I typically do, and I just told Gloria, basically I do this too, because it's been 4 or 5 years. Before the council considers that delegation ordinance, I usually come to a work study session and do a bond 101
Mhm.
and just kind of go over the key stuff. So when they get to see this ordinance, which is like this thick, that they don't get too intimidated or they feel comfortable with what's in there.
Great. Very good. I really appreciate your presentation, and I'm sure you'll be hearing back from us through staff.
Want to meet Lisa?
Thank you.
Thank you.
All right, so do we want to continue with our agenda? Okay, so I go ahead and start, and then I'm going to go grab my phone and tell my 5:30 meeting I'm going to be delayed, so. Oh, I have to draw, yeah. Yeah, so go ahead and I will be right back.
Thank you.
Okay, well, mine is really fast, and I'll try to make it really fast. This is just the audit engagement letter from the state auditor's office. Basically, the same engagement letter we sign every single year. It's just the way our code is written right now. I can't sign it myself, or the mayor can't sign it. It needs council approval, and so the audit has already started. They've been doing their planning. They're well underway. The total cost for the audit this year, they're going to do the financial statement audit, the federal compliance audit, also known as a single audit, and an accountability audit. And the total audit cost is estimated at about $80,000. So our recommended action for today is to place the audit engagement letter with the state auditor's office on the September 3rd, 2024 consent calendar with a recommendation to approve and authorize the mayor to sign. And I can certainly answer any questions about it if you have any.
Anyone have any questions? I don't see any. Debbie is not actually a voting member, so we can go ahead and make a motion despite her absence.
Yep.
Move that we place the audit engagement letter with the state auditor's office on the September 3rd, 2024 consent calendar with the recommendation to approve and authorize the mayor to sign.
Second.
There's been a motion by myself and seconded by Councilmember Gabi. All those in favor, please signify by saying aye.
Aye.
Aye. Those opposed, motion passes unanimously.
Thank you. I didn't realize it was going to be that fast.
We just didn't have any questions.
Ah, thank you. All right, next item is the Executive Department FTE adjustment and new position, and I will turn it over to City Administrator Parks.
There we go. Thank you. So council members, we are coming to you to essentially request a new position titled the Economic Development Coordinator. And as a matter of course, we're also asking for you to confirm and affirm the total FTE count that's associated with the executive department. And I'll explain all that here in just a second. There we go. So just a little bit of background. So we've had some difficulty recruiting and filling the economic development program coordinator position. That's Austin's position. When he left in March, he had made a couple of different recommendations. One was that he felt, and Mike Matlock agreed, it was more appropriate to have his position report directly to the city administrator based on the work that he had done. As you know, Austin was the first person in that type of a position. And so it was sort of a little bit of, my understanding is that question had been asked even before he was hired. So we did do that earlier this year. The other thing that he recommended, in addition to making some modifications to the actual, what we call class specification, which is basically our words for a job description, he corrected it based on some work that he had actually been doing. And then he also strongly recommended that we hire another position specifically to focus on the brownfield redevelopment work. At that point in time, he had been very successful in obtaining the 2 grants that we currently have, but they really weren't yet underway. And there is a significant amount of work in administering those grants, administering the consultant contracts, and then doing a lot of the coordination collaboration associated with that work, which has not yet fully gotten a lot of steam behind it yet, but which will be very necessary. And then, as you know, or as we've discussed, I believe, once you qualify or once you're successful in obtaining both of those types of grants, it opens up a lot of doors for future grants. And so there would be grant writing and even more work associated with the brownfield redevelopment work. So we've had difficulty recruiting and filling that position. We did have a couple of candidates that we interviewed. We actually offered the job to both of them for various reasons of their own. Neither of them accepted the position. So we've been working through that. In the meantime, managing the workload associated with the brownfield grants in particular has been significantly impacting Mike Matlock's time. And it has been a lot of work, and it has been slowed in terms of our ability to continue to move that work forward, just because we don't have the staffing resources to continue doing that work. And there's also become some pretty obvious constraints in terms of resources just to do the work in the executive department. And I won't go into a lot of that unless you'd really like me to. But there's a lot of work to be done. And as I said in the management team, I need my Jay Mason and Sean Crimmins, kind of a lighter terminology. So the strategy that we've come up with is intended to address all of those different concerns. And the first is currently in the Tumwater Municipal Code, there is already established an assistant city administrator position. The idea would be to go ahead and hire somebody to fill that position as one component of this strategy. That actually doesn't require council action at this point because the position already exists. The second component, which is the primary reason for our coming to the council, is that we would create and fill a new economic development coordinator position. So backing up a second, the idea would be to add a lot of the work that's currently in the job description that Austin filled and adding it to that, to the plate of the assistant city administrator position. And then to create this lower level coordinator position. So if you think of a Alyssa Jones Woods type position to specifically support the economic development programs, but to ensure that we're hiring somebody that has specific experience with brownfield redevelopment projects. So somebody who can manage those grants, who can do grant writing, who's worked with consultants and who has a good ability to develop the relationships and the partnerships that we're going to need in order to take those projects forward. That position does require counsel. Counsel's required to actually establish the position and establish a salary range. And then again, because we've done some moving around, we wanted to, and if you approve this particular a new position, we wanted to make sure that we have clarity in the record about what the number of full-time equivalents are that are assigned to the executive department. So again, the assistant city administrator is the existing position. They would continue to report directly to the city administrator. They would be a member of the management team. They would have this economic development oversight. So they would be going, for example, Councilmember Agave, they would be going to the EDC meetings, and they would be, if we had a site selector come in and say, we're really interested in finding a place for a target, then the first point of contact would be this assistant city administrator position, and they would then work collaboratively with the management team to get the information that we needed back to that site selector. So those are the types of economic development oversight that they would be working on. But this person would also be able to help us advance and understand a lot of policy and legislative issues, whether it's a matter of developing our agenda collectively to advocate with the Thurston County shared agenda, to position ourselves with a lobbyist, but also helping to track legislation of a more general nature that might track legislation that might affect us. And also, this position would allow us to have some oversight of different programs. So we currently have a lot of differing issues around our boards and commissions. There's a request to understand a stipend program. There's been some issues with our boards and commissions having troubles getting filled, not understanding necessarily their role, wanting to have more connection with the council. So this is the type of person that would be able to provide some oversight and really be able to launch and take care of some of these special projects that would be helpful from an overall standpoint. And this person would supervise the new person. It may also supervise the communications manager, just because I believe it's 11 direct reports right now. So it'd be nice to give some of those up just from performance review perspective. But that's something that would come later. So right now, the current grade for that position as it's established is at this, the approved salary range that you see there, which is a monthly, those are in monthly dollar gross wage numbers. The new position, this economic development coordinator would be directly reporting to the assistant city administrator. They would be supporting all of the economic development related work of that position and of the city's initiative. But in particular, again, it would be focused on brownfield redevelopment projects, project management, consultant management, grant management, internal and external coordination, collaboration, grant writing. But then they also would be available to assist the assistant city administrator with business outreach, with business retention activities, business recruitment activities. Based on some work that we've already been doing on our salary range, we would propose this salary range at the dollars that you see there, which is grade 54, which is again, that's where the sustainability coordinator is at.
Councilmember Aldozer.
Is that salary range more competitive than what we had advertised for the previous times we tried to hire for it, but were unable?
Right. So this is actually a lower salary range than the economic development manager position. So essentially, instead of having one person at sort of the higher mid-level, we would separate those duties and elevate the oversight into this higher level position that already exists, but then get a more technical, work-oriented position in this economic development coordinator position.
So are the desired years of experience lower. So the idea is that the pool will be different fundamentally because it'll be folks applying who are maybe closer to the beginning of their economic development career
Yes,
rather than someone closer to the pinnacle.
yes,
Okay. got it.
exactly. And again, this is, we've talked somewhat generally that the budget that you will receive, as the mayor's preliminary budget is going to have salary increases for non-represented folks. This would be included in that increase. Right now, this is the salary grade, the adopted salary range for that grade for 2024. And so,
So I have
Uh,
a question. So go back to the, so from, I'm sorry, the coordinator.
oh, okay.
It seems that the technical ability of this person to be at this position is more than an entry level. Seems like somebody who actually know have to have at least anywhere from intermediate to senior technical ability. So, for example, grant writing and doing a project management, those are not something you just walk into. You must have had some kind of prior experience, 1 or 2 or 3 years to be able to do this. So, assuming that if I hear you correctly, that this is going to be somebody who is just stepping into this career position, is there going to be on-the-job training for this person?
Say that last part again.
So do we anticipate that there's going to be an on-the-job training for this person that's going to be stepping into this position? That's why the salary ranges are kind of lower?
Yeah. So I would actually not characterize this as an entry-level position. This is going to be a technically skilled position. So this is somebody who is going to have had some work and experience in brownfield redevelopment. We're going to ask that they have some experience with grant administration. If you think of and somebody who can work independently with minimal oversight. So and I if I could clone Alyssa Jones Wood with brownfield redevelopment skills, that's exactly the person that we're looking
Okay.
for.
Okay. Thank you for the clarification. On that note, is the salary range comparable to, say, within the local area for that particular individual?
So our non-represented folks, the folks that are not covered by one of our collective bargaining agreements are significantly under market right now. So we have taken the step of we're obligated to this salary range. We can't really go outside of our salary and grade range to try and attract people. What's happened is we are often hiring our positions currently we have a 9-step system for each grade. We're typically hiring at steps 7, 8, or 9 in order to get to our market comparables. So at this point, it's not super competitive, particularly at the lower range. But we are talking, when we advertise our positions right now here, starting basically from here on out, we're going to be advertising the salary range. We are going to be advertising that that there's a possibility that we're going to be proposing a market adjustment. We aren't committing to that. We are going to be more than fair in terms of qualifying that. But we are hoping to bring people in, recognizing that we have acknowledged that we need to make some adjustments in order to get our non-represented folks closer to our market.
Okay.
So then the full-time equivalency count in 2023, there were basically 5 positions that were encompassed in the executive department, myself, the executive assistant, and then the 3 communications folks. In 2024, we made this transition to adding the economic development program manager. That was the intent when we were hiring this, when we adjusted the job description for that position and advertised it. that would have created 6 positions. So essentially, if you approve this action and we move forward, the idea is to confirm and acknowledge that there are 7 positions associated with the executive department. One of those is new to the organization. The other one is moved, and that would have been the quote unquote position that was the economic development manager. For clarity's sake, we would not get rid of the approved economic development manager position at this point. It would just go unfilled. So we have several positions right now when you look at our grade, salary and grade system that are unfilled currently. So prior to your approval, for example, the end of last year, approving a senior planner, the budget for a senior planner. We had a senior planner position on our books that's been approved by council. It's within the grade system. It just was unfilled. So in this case, we would want to do the same thing with this economic development manager position so that 5, 10, whatever years down the road, if we had a need for that position, it will have already been created and is still available for budgeting and approving.
Then you could essentially hire for it without councilmatic approval.
No, it would still have to be budgeted.
Right, but you could do it mid-year and then we could do a budget amendment at the end of the year.
It could be a budget amendment. I get budget amendments approved before I spend money requiring a budget amendment. And Troy can attest to that. He's my backup. So the idea we have several positions like that. The requirement for positions is that the council has to create and approve the position and establish the salary range. And then separately, you approve the total full-time equivalency count.
Mhm.
And that's accomplished by virtue of your approval of the budget. We do, those are separate components. And what that does is that allows us to do some adjustments as necessary. And I'll use Mike as an example. Community development, when Brittany came over to executive, she was in a department assistant position and we had 2 permit techs. Mike felt at the time, that's 3 FTEs. He felt at the time, and he had budget available to, that he would be better served by having 3 permit techs. So we hired 3 permit techs. So we were still within the FTE count. We were still utilizing approved and authorized positions at approved and authorized salary ranges, and it was still compliant with the overall budget authority. So those are the 3 things that the council manages and controls. In this case, we're not asking for a budget amendment for either of these things that we're doing. There is budget available in the current budget in order to be able to hire these people, which would probably be at least 6 to 8 weeks from now anyway, or 6 to 8 weeks from approval by the time we go through the process of advertising and interviewing and selecting and getting people on board.
For where it says 2024 confirmed 7 positions, it's those 6 plus also the economic development program manager.
It's the 6 plus the economic development coordinator position.
But that's listed. It says 7 positions. There's only 6 bullets.
There's 2 community engagement specialists.
Oh, I see. Okay. So the program manager, though, is still a confirmed allowed position. It's
It
just
is
unfilled.
correct.
So really, that's 8 positions, right?
So for the executive department for the rest of the year, no, it would be 7 because we wouldn't fill that position.
You wouldn't fill the coordinator position.
I wouldn't fill the economic development manager position.
So confirmed means hired and filled.
Those are the 7 positions
Okay.
that are authorized for the executive department, the full-time equivalencies.
Okay, got it.
Sorry, it is kind of confusing.
do we approve this as a committee or does the council approve it? Because that requested action doesn't say at the meeting, it says that we authorize basically.
So the request, so my apologies for the language in the staff report, if that wasn't appropriate. My understanding from Karen is that this does go to the full council. The
Okay.
two actions are basically establishing the new position and affirming or confirming the total FTE count for executive.
Okay.
And those two things do need to go to the council meeting, and I think the September 3 should be actually September 4 on there.
On the recommended action in the packet, it just says approve and doesn't have a date or anything. So this is just needed to be updated. That's
Yeah.
why I was confused.
Okay.
Okay.
Yeah, my apologies on that. And I had assumed that you would want to take this to consideration. If you're willing to do it under consent, that'd be great, and I'd get them hired ASAP. Well, either way, I would do that, but either way is fine, whatever your preference. I can do it under consideration at the September 3rd meeting, and we can do this presentation for the full council. Or if you'd like to put it on consent, that's your option as well.
So I guess the question then is, what is the proper, what would you prefer?
I serve at your pleasure.
I think given I think it was Councilmember Dahlhoff who was particularly interested in prioritizing economic development a number of years ago. I would think it would surprise me if it would not surprise me if she would prefer this to be on consideration and that we would eventually probably pull it from consent to
Mhm.
consideration anyway.
Yeah,
Just so that I think it's good transparency because I think it's an exciting thing.
Absolutely.
And that people, particularly in the business community, will sort of want to see that. We've had, our sheriff, our Chamber of Commerce come testify at a few meetings. So
yeah.
I would think consideration. But Councilmember Swarthout, do you have an opinion where the
Oh, I
other-
agree. I think it should go to consideration, so the rest of our council mates have a chance to weigh in on it.
Absolutely.
Great.
So I didn't, so I guess I didn't put it on the slide, but really the idea here is that we would then, hopefully, we are appealing, we're sort of elevating the overall oversight of economic development initiatives in the city by getting it into that assistant city administrator position. We are creating capacity in the executive department to do a lot more work than what we're currently able to do. And I feel like advertising for an assistant city administrator that has that economic development will open up the market within which we can draw people in. Economic development is one of those skill sets that is, there's no economic development degree. Right? There's an engineering degree, and so that's what you hire, and there's an engineering certification. So you hire engineers to do engineering work. Economic development is a really a wide range of experience that gets brought to the table. So I feel like we're elevating the economic development function by making the oversight and assistant city administrator position, increasing the pool from which we can pull applicants. And then I believe that having the emphasis on brownfield redevelopment at the economic development coordinator position will open up the field for that work at sort of early mid level of career. That's going to be very appealing, especially since we're talking about the old Olympia Brewery property.
Mhm.
So, if we were hiring right now, what would be the educational qualification or the skill set that they would need to have to step to that position?
So I would want them to have a degree in either planning or environmental engineering or a related field, public policy. I would want them to absolutely have experience with the CERCLA, which is the Federal Clean can't remember what the CERCLA stands for because I use the acronym all the time, but it's the federal cleanup law that is administered through EPA, where EPA grants are focused. I would want them to have a familiarity with the State of Washington Department of Ecology Model Toxics Control Program and the Remedial Action Grant Program. I would want them to be able to have, be able to communicate well in writing and verbally. I would want them to be able to be comfortable meeting with people, talking to people. And I would want them to be able to be well organized and to not get overly frustrated as they are trying to administer grants through the State Department of Ecology EAGLE system, nor through the ACER system, which is the federal EPA grant administration program, which quite frankly is actually easier than the state program, which is
So if I hear you correctly, essentially we're looking for a geologist, an ecologist, and somebody that has some sort of skill in planning. But what I don't hear is somebody who has a degree in economics or government that has the ability to go into a room, enter into negotiation, and be able to apply policies and procedures into actualize those. So for Austin, what Austin was doing was actually in a meeting with EDC, talking about businesses that come to Tumwater, was specific to this particular area. The Brown Street part is just something that happened because that's what we have here in Tumwater. It's not every municipality that have that kind of issue.
So Peter, you were not here then, but Heidi, who used to be like the assistant city administrator, did all of that economic development. She did all of what you're talking about. And then that would fall more into the assistant city administrator role, and they would be out in the field doing those kinds of things. So
the reason why I'm saying is I don't want us to be locked into a position where we bring somebody in who only comes to the job and say, well, you know, I do all of this stuff and what I'm being paid is not commensurate to what I'm doing, and then they leave.
We are, I concur and support what the mayor indicated that the work that you were describing is the higher level work that would be the role of the assistant city administrator. We are evaluating and establishing a salary survey that we've been doing a lot of work to understand what our market is for positions, where we are in that market, and what we need to do in order to get those particularly non-represented positions to market. I feel like, I believe, I used to work with people in the consulting world who were the very specific person that I envisioned for the economic development coordinator position. They have to understand real estate. They have to understand the market. And those are things that they would indeed understand. If there are degree programs through the University of Washington, bachelor degree programs and master's degree programs that are not actual planning degrees, but they are related, and they relate to real estate and market analysis and economic benefit analysis. And brownfield redevelopment is very commonly an economic development strategy. So it is a specific type of economic development activity. And so I would very much expect to have somebody who is happy to work on these projects in Tumwater, in part because of the projects that we've got on the horizon.
Thank you.
any other questions? All right. Councilman Rothhauser.
I would move that we recommend the council approve a new position entitled Economic Development Coordinator with a salary range of $6,049 to $7,368, grade 54, and that we confirm the total FTE count for the executive department to be 7 at the September 4th, 2024 council meeting under the consideration agenda.
So move.
All right, it's been moved and seconded. Any further discussion? All right, with that, I'll call for the vote. All those in favor signify by saying aye.
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 All right, that's unanimous. I don't need to call for a nay. All right.
Thank you. And I will correct the requested action, make sure it's accurate.
Great. All right. Do we have any other business? All right, with that, we are adjourned. Thank you, everyone.
Troy, what is it with